Hi, all right, guys. So we're going to continue on today with business structures. So this will be the third video in the series where we started off with private versus public businesses and liability. And then the second video talks about sole traders and partnerships. And then this third video is going to talk about private and public limited companies. Okay, so you're going to need to open up a newer version of my version of the workbook and copy and paste from the second table to the bottom. Okay, so it starts off with this sentence here: the owners of limited companies are called shareholders and they have limited liability, and there are two types. Okay, so copy and paste that in, and then we'll talk about the next two business structures, and we're going to have 5 in total. So we'll then do another video and some more workbook on the 5th business structure that you need to know about. Okay, so if you think back to last time, that's weird. So if you think back to last time, we had sole traders and partnerships with unlimited liability, which means the owner is the business. So any debts that the business incurs, then they are the debts of the owners. But then we said we've got limited liability companies, which are two types: private limited and public limited companies. And as I said at the time, the clue is in the name. So let's start off with private limited companies. So private limited companies are small to medium-sized enterprises, or often known as SMEs. Okay, small to medium-sized enterprises, although they can get quite large, although there's not many examples of very large private limited companies. And basically, these are companies that are registered, so they have limited liability. The business has its own legal identity, and shares are sold. So you buy and sell shares. You could have one shareholder that owns 100% of the business, or you could have several shareholders owning different percentages. But the key distinction with this business structure is that they are not on stock markets. Okay, so they're not on the stock market. They're not on the London Stock Exchange, the Hong Kong Stock Exchange, the New York Stock Exchanges. They're not on any of them. Shares are bought and sold kind of face to face to people that they know. They're sold privately, which is where the private bit comes into the name. Okay, so they are private limited companies, which means shares are sold to people that they know. Okay, so I could invite one of you guys to invest and become a shareholder in my business because I'm not on the stock market. Okay, this is probably the most common business structure because most businesses are SMEs, small to medium-sized businesses. And in order to lower the risk, they register their company and they become private limited companies because they want that limited liability that we talked about. So if we needed to put into one concise sentence, we would say that these are small to medium-sized businesses with shareholders, and the shares are sold privately. Okay, so what kind of examples are there? Well, Dyson is a private limited company. I'm sure you know about Dyson vacuums and hair dryers and fans. And I think Virgin are as well. So, Virgin Airlines and the Virgin conglomerate owned by Richard Branson, they're also, I believe, a private limited company. They went public, but then once they'd earned enough money, they bought up their shares and became a private limited company again. Okay? So let's have a look at the advantages and disadvantages of these companies. So pause the video, work your way through this table, and then I'll just quickly run through the answers in a moment. Okay, so let's have a look then. I haven't done this, so you'll have to give me a second just to read them. So small business owners can raise permanent capital that never has to be repaid. Shares are a relatively cheap form of finance. So that's obviously an advantage, and that's a big advantage over sole traders and partnerships in that to become a shareholder, you invest money into the business, and that money is never repaid. Obviously, you're entitled to a share of profit, but you never get that lump sum back unless you sell your share on. Okay, so it's a much better source of finance. You're not getting into debt. There's no obligation to repay. So it's a really cheap source of finance. So limited companies are required to publish details of their financial performance. This is costly and time consuming. That's obviously a disadvantage. So there are a lot more accounting things that you have to do. So basically you have to create annual reports, annual accounts, and share them with your shareholders and actually submit them to the registrar of companies. Okay. Shareholders have no management responsibilities, and instead of that elect directors on their behalf. This reduces their workload as owners. Shareholders vote at an AGM. Yep, so obviously sometimes the managers are the shareholders in very small companies, but often the shareholders have no say on the day-to-day business, and that opens up their time to do other things. A private limited company is a separate legal identity. Yeah, it's a limited liability. Private limited companies can only sell privately, limiting expansion. Yep, so the big disadvantage with this is that because they're not on stock exchanges, you're severely limited to how much money you can raise. And when we talk about public limited companies in a moment, you'll see how that's different. Limited liability makes people more willing to invest. That's obviously an advantage. Okay. So this, as I said, this is the most common business structure, just because you get that limited liability. So you only risk the money that you put into the business. You can't lose your own personal assets. So the final one we're going to look at for today are public limited companies, known as PLCs. So these function very similar to private limited companies, and all public limited companies started off as private limited companies. Okay, so they all started off as LTDs, and then they turned to PLCs. So a public limited company, so a definition is that these are the largest type of business structure. They have limited liability, and their shares are sold on stock markets. Okay, so the big difference between a private and a public limited company is that these are the firms that are on the stock market. So if you look at stock markets, or you have a look on the markets, when they're talking about stock markets, they're talking about trading the shares of PLCs, of public limited companies. So as you know, at the minute, the virus has reduced stock market prices by about 30%. We're talking about the value of public limited companies here. Okay, so your Apples, your Googles, your Nikes, your McDonald's, these are all PLCs. So they're the most well-known and biggest companies in the world are PLCs. Okay, and in fact, to become a PLC, you have to be a certain size. You can't just set up one day and say, oh, now I'm going to be on the stock market, I'm going to be a PLC. It takes many years to become large enough to float your company on the stock market. So examples, I've just said a load, but they're the biggest companies that we all buy from. So again, pause the video, have a look through these advantages and disadvantages. There's a few more here I can see, and then we'll run through that, and that'll be almost it for the input for today. Okay, so let's have a look at these advantages and disadvantages then. So many legal documents and company investigations are required. This is expensive. So to become a PLC, you've got to basically have a full investigation into your business. Because if a stock market is going to list your shares, you need to prove that you are a reliable business, that you are making, you're a certain size, and you can cover the costs, and you're not likely to go bankrupt. Okay, so and that kind of appraisal of your business is costly and time consuming. Shareholders vote in meetings to manage the company, and large shareholders can vote out small shareholders, least divorce of ownership. That's another disadvantage. So if you go on the stock markets and release a load of shares in your business, then you can actually lose control of your business, because the people that own your business are not the people that are running your business. Okay, in fact, they might not even be in the same country. They might have nothing to do with the daily operations of the business. So you end up with this separation between what the owners, the shareholders, and the actual people running the business. And this can create problems because the shareholders want to make as much profit as possible, whereas the management might be looking more long term. They might be looking more for growth. They might just have different objectives. Public limited companies can raise more finance. Yeah, so generally when you go on the stock market, it's called the IPO, the initial public offering. You might have also known it as the flotation. And this generates literally tens of millions or even hundreds of millions of dollars. Okay, so it's incredibly lucrative to become a PLC because you get this huge injection of finance when everybody's buying up your shares on day one, and then you can use that to take over other companies. Like when Facebook floated, probably 5 years ago now, I think they floated for 19 billion. I can't remember the exact numbers. And then they bought up Instagram, they bought up WhatsApp, they bought up many other companies with this money from their flotation. As shares of public limited companies are traded on the stock market, the original owners could lose control. Yep, so it's a disadvantage. There could be something called a hostile takeover. So if a company releases too many shares on the stock market, then they might be subject to a hostile takeover, which means that a competitor buys up all the shares and takes control of the company. Okay? Shareholders have no management responsibilities. This reduces their workload. Yeah, that's an advantage. A public limited company is a separate legal identity. Yeah, limited liability. Limited companies are required to publish their details. So yeah, even more so than private limited companies, public limited companies have to publish everything: assets, profit, loss, costs, all information. So if you want to find out how much profit Apple made last year, it's on the internet. If you want to know how many assets they've got, it's on the internet. If you want to know how much cash they've got, it's all freely available, because they have to share that information in return for being on the stock market, so people can make informed decisions about what stock to buy. There may be a large number of shareholders. Keeping them all informed may be expensive. Yep. Okay. So we're obviously going to have thousands, possibly millions of shareholders, and keeping them all informed could be very expensive. Okay. Right. To wrap this video up then, so we've got a summary table. Okay. So we've got the 5 that we've talked about so far: sole trader, partnership, private, public, and public sector. And then what is the ownership like? So for example, one owner. What is the size? What type of liabilities do they have? Who takes the profits? And how much access to capital? So basically, how much access to finance do they have? Okay. And then if you want to push yourself a bit, there is an extension task here talking about limited liability and an example of limited liability and the fact that we take it for granted, but it wasn't always the case. And that's it. Okay. So hopefully that's nice and clear. So you should know about sole traders, partnerships, private limited, public limited, limited liability, unlimited liability, and private and public sector firms. Okay, hopefully that's quite quick, pretty straightforward. We'll do some more work on this in the future, because that is quite a lot of information to take in and recall.